Welcome to the Broken Pie Chart Podcast, episode 323. I'm your host, Derek Moore. We had a negative GDP print this week that came out, minus 0.3%, although unrounded, minus 0.28, close enough. And a lot of talk about this one. So I thought it'd be good just to kind of go through. It was, like I said, minus 0.3 rounded. How bad was it? What was the cause of it? I mean, so when you look at GDP, there's personal consumption, fixed investment, government consumption, change in private inventories, and net exports. The net exports meaning if you're exporting more than you are importing, that is, that's going to be a negative number. Did I mess that up already? Basically, all right, exports minus imports. So it's like if you have a trade surplus, if exports exceed your imports, so you're exporting more than you're importing, the country has a trade surplus. If imports exceed exports, it's a trade deficit. So a big part of what happened was when you have a lot of the front running for the tariffs, and this is the sort of the talk on Wall Street, people bought stuff ahead of the tariffs because they wanted to get it in. I mean, and although, so yeah, I mean, it was like minus 4.83% was what that section was. And so let me explain this to you. Personal consumption was plus 1.21% annualized. Fixed investment up plus 1.34% annualized. Government consumption down minus 0.25% annualized. Change in private inventories, plus 2.25% annualized. Net exports, minus 4.83%. You sum all those, you wind up with minus 0.28, rounded 0.30. Okay. So then you say, well, what would happen if you took out the net exports portion? And I'm not saying you should do that. It is what it is. It would have been an annualized plus 4.55% real GDP growth rate. And so the reason why I bring this up is it's going to be very interesting to see what happens when you go and let's say we're in the tariffs and we're looking at Q2 and there's not stuff being front run. Do you see this flip back? Now, obviously, you could have changes in all these categories. I will tell you that it's instructive sometimes to look back. And, the last time we had a negative GDP, let me see. This would have been, let me get the date here, March. So what did it come out? The final Q1 would have come out in March. Yeah, so Q1, March of 22, gross domestic product was worse, minus 1% annualized. And you look at the offender there, it was net exports, that one, minus 2.4%. Personal consumption up 0.64%, fixed investment plus 1.44%, government consumption down minus 0.6%, change in private inventories minus 0.1%. So net exports was kind of the culprit then. And I don't remember, that might have been we ramped up our exports. Wasn't that the beginning of the Ukraine war where we were doing extra natural gas or energy? I don't remember. Doesn't matter at this point. So you kind of look at that and you say, all right, I mean, if you import more than you export or export more than you import, I mean, that number can be definitely, changed there. It is interesting too. I mean, somebody asked the question to me. I was talking to someone the other day, and they said, didn't all the stuff that we imported go to private inventories? And yeah, I mean, you kind of get it in private inventories, and that's certainly, an aspect there. If people are bringing in stuff, they're going to throw it into inventory. So we'll see what happens there. But I just thought I would go through it because sometimes there's a little bit of a misunderstanding as far as what really we're looking at there. Some other people said, well, are we in a recession now? No. Now, the technical, recession is 2 consecutive quarters of negative real GDP. We've had one. I don't know why we say it technical. The reality is the NBER, National Bureau of Economic Research, is the ones who declare recessions. And often they don't declare recession until months after it's actually started, and they don't tell you it's over for months after it's ended. So take that for what it's worth. All right, let's talk about markets a little bit. And we had a very good jobs report. And so if I'm looking over here at, look, the market, contrarian indicator alert. Somebody had sent me this. Barron's, their cover, and I say that it's a contrarian indicator because sometimes the Barron cover is like, stocks are screaming buy, and then that's the top, or, you should sell everything, and that's sort of the bottom. But their cover is a picture of a sullen-looking bull, and the title is, "Where Did the Bulls Go?" The percentage of bears in and this is Barron's, latest big money poll is the largest in almost 30 years, where the pros see value now. So you'd have to go to page 16 for that. I did not do that, but seems like people are really, really bearish. And I checked in on the AAII. That is the American Association of Individual Investors. I don't know who is getting these surveys, but still very, very bearish sentiment. Very bearish sentiment. In fact, Bespoke had something out on Twitter. Consecutive weeks, AAII, bearish sentiment greater than 50%. And it has been, how many weeks is this? It's like 10 weeks. And according to them, AAII bearish sentiment quietly remained above 50% for a record 10th straight week this week. It actually ticked up to 59.3 from 55.6 last week. And you kind of look at this and, right around 1990, I think it was 7 weeks. Then you see, 07, 08, 09. You had some 4-weekers in there. Let's see. Is that 2022 maybe? It's tough to read this. But my point is that it seems like there is just a groundswell of bearishness. Are they right? I'll let you know in 6 months. But it's kind of one of those things where, remember, 29 of the 30 leading economists said we'd have a recession in 2023. Nobody knows. And Wall Street normally, I've said this before, Wall Street normally thinks it knows, but it doesn't. In the beginning of April, when the tariff stuff started, I said Wall Street normally thinks it knows, but it doesn't. Wall Street doesn't know and is saying it doesn't know because they're having trouble putting out future earnings forecast. So not only do they not think they know, but they don't know. So we never had a bear market. And who is this? This is Ryan Dietrich on Twitter. I put this thing out. Another 19% correction. And the S&P 500, 15 to 20% corrections, 1950 to current. So the technical bear market is on a closing basis, you get 20% or greater close to close from the prior high. So you look at these, and we just had one, 219 to 48. Who knows if that's the low, but at this point it was the low, minus 18.9. And the length of that one was 48 days. And what's interesting is the first day return after correction ends, plus 9.5%. Remember that was the day the markets traded in a range in a few hours more than some annual return years. Just the realized volatility in the market through April, even though we're basically unchanged through April, it was kind of amazing. So you look at these and you say, well, when were these periods? Okay, September 20th, and I remember this one, 2018 to 12/24, 2018, the Christmas Eve bottom, 19.8, so it didn't get up to 20%. And you look at this and it says, well, 1 month later, plus 13%, 3 months, 6 months, 1 year later, plus 37.1%. I'll give you one other. I'm not going to read these all, but April 29, 2011 to October 3rd, 2011, minus 19.4, a year later, plus 31.5. So there's been 1, 2, 3, 4, 5, 6, 7, 8 of these. I guess they only go back to 76. This says it goes back 1950 to current. So maybe there weren't any prior to 76. But you look at this, and the median return 1 year later is plus 31.5%. Look, I don't know what's going to happen with the markets. But is there something to this where if you get down 15 to 20% and you never went down greater than 20%? I don't know. I'll let you know in 6 months. Now, when you look at the markets, I think it's instructive to think about, we've definitely had a bounce. I mean, we basically retraced all of the April declines. So we're not making new highs. I don't know if we'll make new highs, but we're certainly recovered quite a bit of the downturn. And who had this out? Who put this out? I want to try and give him credit because somebody sent this to me. It will come to me. It will come to me who this is. But they said, let's look at the indices and stocks that are percentage of stocks that are above their 20-day moving average. And the S&P 500, 86.6% of stocks. NASDAQ 100, about 93%. Above the 50-day, NASDAQ 100 stocks, 61% of them are above their 50-day. S&P 500, 56.4. Above the 100-day moving average, 44% and 41.8% respectively, and above the 200-day moving average, 51% and 44%. And I think the reason why they did this is they kind of said, well, in very short term, it is either very bullish or bullish. But then if you look at the longer term, it's sort of neutral. It's kind of neutral. They don't put it as really bearish, although there are parts of the market, let's say the S&P 1500, for example, above its 100-day moving average is only 32%. So what does this mean? It means the market has more technical work to do. And I've heard a lot of people saying, is this the start of a new bull market? I don't know. Or is it a technical dead cat bounce? Will the market make a new low? Will this just go sideways? So, I would say that I think the level of bearishness and this, what do we have? 9 straight days S&P up. Just the level of bearishness means that I think there were people who sold. There were people who went to cash. There were people who maybe were short, betting against the market. And when the market has that violent reversal and continuation, sometimes you see short covering. Sometimes people say, well, remember, I always say this, if you want to try and time the market, you got to be right twice. You got to be right when exactly to get out and when exactly to get back in. It's really hard because sometimes the biggest down days and the biggest up days are right around each other. And I didn't bring the statistics on for this podcast, but imagine you missed the 9.5% up day. Like, that's really significant. So I'd much rather see people stay invested, be hedged, be buffered, those types of things. What's a little surprising, though, when you look at maybe some of the, I don't know, you kind of look at the different indices and asset classes. We'll call them asset classes. And you can do this looking at ETFs, for example. Did anybody have gold this year being up 23.1%? This is as of 5/2 from Charlie Bolello. He put together a table. UEFA stocks, international developed. Who had international developed? Imagine coming into the year and be like, yeah, I'm going to buy 50% gold and 50% developed international. That's up 13.9%. Really? And I'll sprinkle a little emerging markets, which is up 5.6%. And TIPS bonds, which are up 3.5%. This is like, nobody was positioning that way. Remember, I think it was in 23 or was it 24? I forget. They said, no, this is the year for international. It wasn't. Look, I don't know what's going to happen going forward. I'm just saying. So what hasn't, the S&P large cap, SPY, down 3% for the year. Incredible, because remember, I just said we were down, 18.9%? I think we were down over 20% on an open, a non-closing basis. NASDAQ 100 minus 4.2%. So this is the thing. Like, and I've seen some articles saying now's the time to rotate to developed international. Well, I mean, probably a little late. I don't know. Maybe it outperforms for the rest of the year. I'll let you know when I know. But I think there's too much reaction right now to the daily gyrations in the market and the news. And we know that time in the market more important than timing the market. This is why we're proponents of being hedged, just staying invested in markets. We know that, and if I talk about performance, that's a whole other thing. You can go to our website, zegainvestments.com. When I say a whole other thing, there's disclosures and things like that. So I'm not going to talk about performance. But I will tell you that, people who had hedges were probably glad they had hedges because it could mute some of the downside. You can always check that out on our website. So then what else is going on in the markets this week? Well, we had employment. And unemployment rate was 4.2. It was basically, unchanged from the previous. Although if you do the math, I always like to do a little math and see what the non-rounded number is. But there was some good in here. Actually, it was fairly good. And non-rounded 4.187389325 for those of you playing the home game. So participation rate clicked from 62.5 to 62.6. The civilian labor force grew by 518,000. Civilian non-institutional population grew by 174,000. Employment population ratio went up. Unemployed went up by 82,000, but employed were up by 436,000. So, that's kind of significant. And the civilian labor force actually, sorry, I misspoke on that. It declined. So 343,000 people came out of the labor force. That could be retirements. It could be, remember, you're either employed or if you're considered unemployed and in the labor force, if you're looking for a job within so many weeks. You're not in the labor force if they call you and they say, do you have a job? No. Do you want a job? No, I'm good. You're not part of the civilian labor force. You're out of the labor force. So, remember, this was the thing. Wait till the government layoffs are in there. Well, they're starting to be in there. And if they're paying people towards, if they're remaining on the books for so many months, but we've seen private job creation start to outpace, it has outpaced government job creation. And that's flipped because I think in the last, was a year ago or year and a half, 2 years ago, the government was definitely, leading the charge there. So we'll see on this. I think I will say Liz Ann Saunders put out a tweet of a graph by Arbor Research. And this is the job stayer versus job switcher. And this is wage growth for job switchers and job stayers, 12-month moving average of median wage growth. And job switchers now are 4.7%, 4.6% raise for wage growth for job stayers. You might remember that coming out of 22, and the height of this was people switching jobs were probably 7.6%, where the stayers were only closer to 5.6%. There was this gap. And so people were leaving their positions. Why do I bring this up? Well, it means that people aren't just able to go switch and make a lot more money. And so does this mean the job market is getting softer? I don't know. I don't know if we see that yet in the data, but it is something to look at. And this chart doesn't go back to before 2020, but I would be interested in, this is something maybe to keep an eye on. All right. You want it, you want the sell in May go away. Is it time to sell in May? Well, not necessarily. Ryan Dietrich also put out a tweet. He said, maybe we should call it sell in June. I don't know why he said June. June's not mentioned on this, but S&P up in May, 9 of the past 10 years. Okay. And this goes back to 2015 through 2024. 2019 was minus 6.6. Every year of the year was positive or flat, like 2022 was flat. So I think this has been debunked. We actually know that, what is it? September, August, September, October are kind of the months that, you typically see some of the downturn. It doesn't mean you should sell and get out and go to cash because you don't know. But, and then you say, well, wait a second. What about the worst 6 months of the year? Well, same person, Ryan Dietrich, said, is this Ryan Dietrich? Yeah, it's him again. So he said the worst 6 months of the year here, various S&P 500 index 6-month returns. So apparently November to April is plus 7.1%. That's 1950 to current. And May to October is plus 1.8%. But it's still positive 65.3% of the time. And, I don't have the individual numbers like on the months, or I didn't pull that. But anyway, it's, just be hedged. Be hedged, be in the market, be hedged. All right, what else can I talk about? We talked about the bearish sentiment. One other thing I've noted too, remember I did a podcast, I don't remember which one it was, otherwise I'd link to it, but I looked at US GDP nominal year-over-year change. And nominal year-over-year change does not adjust for inflation. So real GDP adjusts for inflation. So in theory, if like GDP was up 10% in a quarter, but inflation was 10%. It doesn't exactly work out like this, but just kind of conceptually, you had no real growth, but you had nominal growth at 10%. Got it? So it slipped under, this is from Liz Ann Saunders on Twitter, it slipped under 5% year over year annualized, just year over year. So 4.7%. And remember, well, hopefully you remember, you listened to all the episodes. When you go back in the 1990s, it was pretty consistently above 5%. And then after the great financial crisis, when you had zero rates, which is kind of interesting because, the Fed kept rates at zero, was doing quantitative easing, buying bonds, adding to the balance sheet, all doing all those sorts of stuff. And we really didn't have nominal GDP over 5%. It went back above 5% in early, when is this? Maybe 2021, 2022, one of those years. And then it's been coming down. But one of the things I sort of said was, maybe we're going to be in a period like the 1990s where you have some consistent above 5% nominal GDP growth rate. We'll see. We'll see what happens. We do have a Fed meeting coming up this week, May 7th. And if I look at the probability for rate cuts, last time I checked, and I should have brought this up before I started talking about it, but I'll look at it now. It is a 3.2% probability of a cut at the May 7th meeting. So basically they're saying not going to be a change. They have a 34.5% probability at the June meeting. And let me see. And it looks like July is the one where it looks like they have forecasted a 0.25 point rate cut. Remember, these are based on the Fed funds futures. These changed a lot. These are going to change a lot. Like if I change the date on this and I look at what it was forecasting, but essentially through the end of the year, they are forecasting about 0.75 point rate cuts. And that would bring the implied rate down to 3.53 from where it is today at 4.33, the effective rate. So I don't know. I mean, I feel like Powell and the Fed may dig their heels in a little bit, and they might just say, okay, we're not going to lower interest rates. But, remember Jay and I talked about this a couple of years ago, and we talked about it in the depths of inflation, and everyone was like, the Fed causing inflation. The Fed, they could have just kept rates where they were. This is my opinion. Remember, they were raising rates. And the rise in rates really is what caused the bear market in 2022. It was Or bonds went down. When you discount cash flows back to the present, you got to discount them down, all those types of things. So, the problem with when you look at what the Fed did or didn't do for inflation, I don't think it really mattered. And Jay and I talked about this. I wish I could remember which shows. You could go back and scroll the ones from, 2021, 2022. Well, we said, I don't think the Fed should have done anything. Like, the Fed did not cause the inflation. The Fed was trying to react, and they didn't want to seem like they weren't doing anything. But raising rates didn't kill inflation. And, inflation, when it's demand driven, is one type of inflation. When it's supply side caused, the worst thing that you can do is sort of pour gasoline on the fire, lowering rates, doing stimulus, doing more fiscal stimulus. And really, it was the fiscal stimulus. I mean, to simplify it, when everybody got checks, they sent out money, they had PPP, they had AAII loans, they had mortgage forgiveness, they had rent forgiveness, they had student loan pauses, like all this stuff. Think about the money that was awash in the economy. And then what did people do? Well, the economy was still sort of closed down. So experiential stuff, meaning vacations and services and things like that, they weren't spending the night. They were buying stuff on Amazon, and it was getting brought over in container ships from China. And you had this demand surge. At the same time, you had supply side issues. And that's what caused the inflation. Like, they didn't send people checks and throw money out of a helicopter. It wasn't the Fed. So I don't know. I mean, I think the Fed is going to dig their heels in. I don't think they're going to do anything. And I think this Fed also, there hasn't been a meeting yet where they have done something that wasn't expected. I think Powell and his Fed has been very transparent, and they have given clues and given guidance on the market and all the interviews and things they've done up to this point. So I don't expect they'll do anything. And quite frankly, I'm not sure it really matters. I mean, it would help housing. It would really help housing. But, there's that. I will tell you that, and I'll put a link to this. I think, let me see, this is a couple of places. But on Yahoo Finance from Business Insider, says Treasury Secretary Scott Bessent says bond yields are signaling it's time for the Fed to cut rates. This is a little bit of, talking your book. I mean, they want rates down. They want rates down. People want lower rates. It would help the housing market. And his point was, and let me just get the quote here. He went on Fox Business on Thursday, and he said, we are seeing the 2-year rates are now below Fed funds rates. He told Fox Business on Thursday. I'm quoting this, right? That's a market signal they think the Fed should be cutting. And the 2-year Treasury yield is about 3.56, below the effective funds rate of 4.33. And this has been on display since at least mid-February, when the 2-year yield surpassed 4.36. So, and they wanted to talk about, this is what I've been saying. The White House has made interest rates a key focus this year as it looks to bring down borrowing costs for consumers. But the Fed's hands may be tied for now as it deals with still elevated inflation and a slowing economy. I also think it's a little bit lazy to say too high inflation and a slowing economy. We'll see on the economy. But I will tell you that, when I look at the CPI year over year, the one that was released in April, we'll get another one in middle of May. But all items plus 2.39%. And I did another episode. I wish there was a better way for me to find the episodes. Maybe I'll have to look into that, and I would link to it. But if you go back, we had explained inflation is very rarely within a certain percentage of 2%, since they've somehow come up with a 2% target. It's not really there. It's below, it's above, and 2.39%. It's not 2, but it's not 10. Core CPI 2.39%. let me see, 2.789. And, you look, and that was from March. I look back, and no, that's probably the lowest print since sometime in 2021. You could look at Supercore, which is basically services minus energy and housing. And Supercore was plus 2.864. And that's the lowest print since probably April of 21. So I'm just going to say, I think it's a little lazy to keep talking about how inflation's high. And it's actually been coming down or relatively stable. And I point out again, I wish I still had I tried to just find it very quickly, but I did this analysis and I said, since they came out with a 2% target, how often was it within 25 basis points of 2%, meaning between 1.75 and 2.25? It's not that much. Percent is not that much. So, I mean, inflation's around there, but it never really just sits at 2% and stays there. I don't know. I just think it's lazy. Sorry, news reporters, but I think you're being lazy. So, all right. What does all this mean for markets? I mean, we're still in earnings season. We came through a big part, like the biggest part of the earnings season. NVIDIA is the last one, the last big one. We have AMD this week, which is, of course, also, everybody thought that was going to be, if you don't buy NVIDIA, you buy AMD, and that one really hasn't done as well. In fact, I go back to the whole idea of, you look at something like the SOX index, and you look at a chart of the SOX index, and, its highs were back in, July of 2024. And it's off the highs. It's still off the highs. It's off the lows. But it's still, it hasn't been a new high. I remember, so the SOX index of semiconductors made an all-time high July 10th of 2024. The Mag 7 makes an all-time high December 17th, 2024. The market makes an all-time high February 19th, 2025. So just kind of think about that. Like, semis have been trailing, and that's supposed to be the picks and shovels, and the CapEx spending is going there. So, I think NVIDIA earnings, I don't have the exact date, but that's still a big one to watch. AMD this week. And by the way, the VIX index continues to fall. And, so that's that. All right, I'm done. Recommendation is to watch hockey. Watch the hockey playoffs. And for our listeners in Canada, congratulations on your Toronto Maple Leafs finally getting out of the first round. They, for those of you who don't follow hockey, it's kind of the Maple Leafs, and they're kind of like the Yankees. They've got a huge fan base, but they haven't won in a long time, and they have trouble getting out of the first round. In fact, Minnesota Wild, I think I saw a stat, they've been in the playoffs like 7 years straight, or maybe it's longer, and they haven't gotten out of the first round. So it's enough hockey talk, but Florida Panthers, Toronto Maple Leafs should be a good series. And if you haven't watched hockey, you should check out the playoffs. It's an incredible sport. And the playoffs, there's just nothing like it, the intensity in the NHL. The only other thing I think I watched this week, I watched Survivor because it's in like the last couple. I know you can make fun of me. I don't care. I still watch Survivor. Maybe I'm the only one. But all right, that's it. Derek.moore@zegainvestments.com, DEREK.MOORE @Z as in zebra, E as in Eddie, G as in George, A as in Apple. Investments is up to you to spell correctly. Had a nice note from somebody who read the book Broken Pie Chart, and they enjoyed it. So I'll just remind people that's on Amazon. You can get Jay's book, Buy and Hedge. And then I co-wrote a book called Effortless Public Speaking with Liam Sanford about how to get better at public speaking, that we've had a really good response to. It was kind of a side project, a fun project, but that's out there. All those are available on Amazon. The links are in the description. So if you're looking for a Mother's Day gift, what a great Mother's Day gift that would be. I would pick one of those up. All right, everyone. We'll see you next week.